Amazon, Microsoft, all sitting at record highs this morning, helping drive markets to new heights. Some investors are now concerned that the market is already overvalued. Joining us right now, the chief investment strategist at CFRA Research, Sam Stovall. Sam, good to see you.
Good morning.
Thanks so much for joining us.
Happy to be here.
How do valuations look to you?
They don't really look all that bad. I mean, right now we're trading at a little less than 17.5 times 2018 estimates. When you look to longer-term averages, yes, it's about 16.5 is the average, but you also have to factor in inflation. Inflation still remains very low, and so when you have a low inflationary environment, that can actually support a higher multiple.
Sam, one of the biggest things that needs to factor into investors' considerations is the cost of capital, and that's going up, especially as we're seeing the Fed come on next week with their meeting. That's one of the biggest events that's going to happen so far, because that's going to give indication for the rest of the year. Is the Fed going to raise rates 3 times this year? Are they going to raise rates 4 times this year? How should we be looking into putting new money to work going into the fact that Fed's going to raise rates next week?
Well, our feeling is they're going to be raising 3 times this year. And I think you also have to put things into perspective. Historically, the Fed funds rate is about 1.5 points above the rate of inflation, which means we should be at 3.5%, not sub 2% on Fed funds. Also, historically, the 10-year note is usually 1 percentage point above that. We should be close to 4.5%, not sub 3% where we are now. So, you know, my feeling is that, yes, even though the trajectory is higher, the yield curve is still positive. The 10-year minus the 2-year is about 40 to 50 basis points. Historically, we have to be inverted by 60 basis points before we start to see a recession.
Sam, I want to bring up this report. We brought it up at the top of the hour, where you have 6.7 million job openings in this country. And that's more for the first time since at least 2000 than the 6.3 million Americans who are unemployed during that month. But what does that do to the outlook for stocks and even bonds? Because that would suggest that you are going to have pay raises by these companies to find workers, even keep workers. That could, it either trickles through to consumer prices, or it puts pressure on corporate profit margins if they can't pass on those higher costs. It seems to be some real inflation percolating in this report. Not that that's a bad thing, but it would certainly have an impact on stocks and even fixed income.
Sure. Well, I think that's sort of the $64,000 question. How much will the low unemployment rate and, as you had said, you know, more jobs than people at this point, what kind of upward pressure could that be placing on inflation? Our expectation is core CPI, which is now around 2.1, probably comes out to about 2.3% year on year by the end of this year. So expectations are that it's not going to be going parabolic anytime soon. I think one reason is because of technology and so forth, a lot of the middleman has been removed from the equation. And so the consumer going directly to the supplier has been able to keep inflation low. So we'll just have to wait and see what kind of a ramp up there really is.
Certainly feels good out there, but this could become an issue at some point, the fact that there are more openings than actually people to fill them, jobs.
Sure. So I think that's what people are going to be keeping their fingers on the pulse of inflation, of interest rates, and therefore what kind of an effect could that have on the overall market.
How does the backdrop feel to you? We have a lot more buybacks and dividend increases. How does that affect valuations?
Well, we estimated, you know, friend of yours, Howard Silverblatt at S&P Indices, estimated basically that buybacks over the past several years have added about 4 percentage points to earnings over an extended period. So buybacks have been very, very important. But that was really when the top line, when revenues were not growing that dramatically. And so as a result, companies had to sort of artificially boost their earnings per share.
But that's different today, right? Tell us about earnings and revenue in the backdrop in terms of this
market.
For
2018, the estimate is we're going to be seeing earnings above 20% year-on-year change. For 2019, the estimate is now above 10%. For revenues, we're looking at about 7% revenue gains. So revenues are actually a lot stronger than they have been over the past several years. So things are looking good. If you want to be concerned about something, you just have to say to yourself, are things beginning to look too good? You start looking for words like boom all the time in terms of headlines. And as Jim Stack from the Stock Traders from Investec will tell you, whenever you see the word boom too many times, that's not a good thing.
Yeah, but are you expecting a slowdown in the coming years? When do things start slowing down in your view? Because we've been talking about a narrative of the end of 19 and 20 and really a watch on the consumer.
Yeah, well, I mean, every Republican president since Teddy Roosevelt has seen a recession that started in their first term in office. So I don't think I'm making a bold prediction by saying that we'll probably fall into recession before the end of President Trump's first term in office. Okay. That would be 2020. So I know we've got a ways to go yet.
I was just going to point out, because we talk about the upside and the downside of all of these job openings and the desire to hire. Eventually, a company will pull back on capital spending and investment if they can't find the workers. They're not going to talk. They're not going to talk about expanding a plant or opening new restaurants if they can't find the staff here in the United States. I don't want to. I don't want to play. I think this is nothing but.
But it's
good
a
news,
big story.
It's a huge.
Yeah.
It's a big story. But also, what I find is that companies end up saying, "Well, if I can't find the human power to do this, maybe I will be focusing more on the technology power." And I think that's the reason that technology continues to do well, even though it's now trading at about 19.5 times 2018 earnings versus 17.5 for the S&P 500. Tech is trading at a premium right now. I think investors are saying tech usually does well in a rising rate environment, and if we have a tightening job market, companies are going to be improving their technology and their productivity.
We'll leave it there. Sam, great to see you.
Thank you.
Thank you so much. Sam Stovall joining us there.